Last week, a client of mine called and said, I know how much I have saved for retirement, but I want to know how much other people my age have saved for retirement. And this is a really common sentiment, right? To want to know how you're stacking up against others in your age group. Well, thanks to two major studies, one by Vanguard every year titled How America Saves, and the other one done every 3 years by the Federal Reserve called the Survey of Consumer Finances, we know exactly how much Americans have saved in each age bracket. If you're new to the channel, hi, my name is Julia, certified financial planner, and over my many years in financial planning, I've analyzed hundreds of retirement plans and noticed clear patterns in how savings typically accumulate during the pre-retirement years. And that's exactly why I'm making this video today, to show you the real numbers for average retirement savings for three different age brackets: 35 to 44, 45 to 54, and 55 plus, so that you can see where you stand. I encourage you to stay through to the end of the video because we're going to discuss a couple rules of thumb to determine how much you'll need for your own retirement, as well as some action steps to get there. I want to start off by saying that if you feel unprepared to retire, you are not alone. In fact, according to a recent study by the Federal Reserve, only 41% of people over the age of 60 feel as if their retirement savings are on track. My hope is that if you're in that 41%, once you see these numbers, you'll feel much better prepared. But before we get into those numbers, we need to understand the difference between an average and the median, as we're going to be reviewing both, and they mean very different things. An average is the sum of all values in a data set divided by the number of values, whereas the median is the middle number, meaning that half are above the median and half are below. So let's use an example. Let's say that there are three people with retirement savings of $100,000, $250,000, and $800,000. The median is simply the middle number in the data set. So here it's the $250,000. So 50% or half have savings below that number, and the other half have savings above that number. The average would be all of these savings amounts added up and then divided by the number of data points, 3. So the average equals just over 416,000, which is kind of interesting because we know that between these three individuals, only one of them has savings above this average, but that's just how an average works. One large account will skew the data set. So when it comes to retirement savings, I think that the median number is the most helpful. So let's get into them. Let's start with the Vanguard's 2023 study, which looks at just 401k balances held by their firm. And FYI, their information holds a lot of weight as they are in the top 3 401k providers in the nation. For folks in the first age bracket between 35 and 44 years old, the average 401k balance was $91,281, while the median was $35,537. So if you're in that age bracket, you can now gauge your position in terms of the average, but more importantly, the median. To refresh, this means that half of the participants have 401k balances below $35,537, and half have balances above that amount. For folks in the second age bracket between 45 and 54, the average 401k balance was $168,646, while the median was $60,763. And for those of you in the top bracket, ages 55 plus, your average 401k balance was $258,669, and the median was $88,169. Now, while this study is helpful, it's slightly misleading because it only shows one part of your total net worth. All of our clients have assets outside of their employer retirement plans. Think IRAs, Roth IRAs, bank savings, brokerage accounts. And the study done by the Federal Reserve gives us a more accurate picture. So let's look at those numbers now. For our first age bracket, 35 to 44, the average total savings is $141,520, and the median is $45,000. For folks age 45 to 54, the average savings is $313,220, and the median is $115,000. Now I'm going to break out the 55 plus age bracket into 3 different groups. 55 to 64, these folks have average savings of $537,560 and a median of $185,000. Now for ages 65 to 74, these folks have average savings of $609,230 and a median amount of $200,000. And for the age bracket 75 plus, these folks have average savings of $462,410 and a median savings of $130,000. And this makes sense, right? So if you retire at a normal age, 62 to 67, your savings are going to be the highest just before you begin withdrawing income. When I first saw these averages and medians, I have to admit I was a little surprised. I don't know about you, but I think it's really easy to assume that we're somehow not doing as well as others. Everyone struggles financially at some point in their lives, and I do think we tend to underestimate the financial struggles of others. One, because money is not something we talk about, and two, because as Americans especially, we prefer to show off how well we're doing, right? Flashy cars, big houses, fancy jewelry. Most people want others to think that they're doing better than they actually are. So I think that's what contributes to it. And I also feel like our news around retirement today is dominated by extreme outliers. The folks who retire at 45 or 50 successfully, when the reality is that 99% of people are still working between 62 and 67 and saving quietly. Not to mention the fact that our media tends to portray retirement as a race with winners and losers, when the truth is that most Americans retire gradually between the ages of 62 and 70, not in a sudden victory lap at 55. So if you found yourself at or below those averages and medians, you might feel discouraged, but you shouldn't automatically determine that you're behind. Your total retirement assets are likely much higher than these averages and medians when you factor in your home equity, rental properties, Social Security, and pensions. Most people discover that they have 30 to 40% more saved than initially calculated. Now, every person's retirement is different, right? So, one amount of savings may be great for one family, but not for the next. And this is why it's so important to get retirement advice that's tailored to your exact circumstances. That's why I created a separate video that goes beyond the data we've covered today. In this video, I'll show you how to take some of the most important principles of retirement and transform them into an actionable plan that works for your specific situation. You'll learn my complete framework for building a retirement strategy that helps you avoid becoming part of what we're discussing today, right? Being below or average. So if you're ready to move beyond these averages and start to create your own retirement roadmap, click the link below to access the free video. All right, now back to this video. There are a couple rules of thumb around how much you need to retire. The first is the 80% rule, and the second is the 25x rule. The 80% rule states that you should plan to live on 80% of your pre-retirement budget to maintain a similar lifestyle in retirement. So if you're spending $100,000 currently, you should plan to spend $80,000 in retirement in today's dollars. Now, I'm not a fan of this rule of thumb because it's just not the reality of what we see with our clients for the past 15 years. So what we see is that even if a client has a mortgage paid off by retirement or some other reduction in their expenses, at the very least, it's made up for by increasing retirement costs otherwise. So travel, home improvement, medical costs. What we more often see actually is an increase in spending during the first several years of retirement that gradually decreases as you age. The second rule of thumb is the 25x rule, which states that you need to save 25 times the amount you expect to withdraw from your investments each year. So if your income gap or the amount that you need that isn't covered by Social Security, pensions, or other sources of guaranteed income is $60,000 per year, then this means that your total portfolio should equal $1.5 million when you retire. Unfortunately, this is just another way to say the 4% rule, which I've discussed at length in previous videos. So if you've watched those, you know that I'm not a fan of the 4% rule because I think it's far too conservative for most retirees. For one, we don't spend in a linear fashion, meaning that nobody spends the exact same amount of money every single year. And two, we find that our clients can actually withdraw a much higher percentage safely in retirement. Rules of thumb are great for do-it-yourselfers or to get a start in planning, but they fail to account for individual variables. So it's important that you take the time yourself or hire a planner to customize your approach to your needs and situation. So what are some steps that you can take now to gauge your own retirement readiness? Let's review the three-step process. First, you need to run a complete financial inventory. All accounts, debts, and assets, including overlooked ones like old 401ks, home equity, future inheritances. And within this inventory, I want you to track your spending for 90 days. The reason why I want you to track it as opposed to estimating it is because estimating spending does not work. And I know this because I help folks through this process every day. And I'm telling you, people always think they spend less than they actually do. So really, please keep a running record for 90 days. Second, map out your expected retirement lifestyle and the cost. It's not enough to use a generic 80% or 100% of current expenses because there are just too many variables. You need to consider where you'll live, your healthcare needs, and which expenses will disappear once you retire: a mortgage, kids' college costs, commuting to work, and which expenses are likely to increase: travel, hobbies, etc. Remember the typical pattern of retirement spending, otherwise known as a spending smile. This means that when you first retire, you're spending the most, right, when you're still young and healthy. And as you age, you'll spend less and less. Now, the other side of the smile comes from potential long-term care costs. Now you can compare your current assets and savings rate against your actual needs. Find your income gap, which again is that difference between guaranteed income and how much you actually want to spend. This is what your portfolio will need to fill, and it's the only number that actually matters. So now that you've seen how your retirement savings stack up against others your age, you need to understand one thing. These average savings figures are just baseline numbers, and they don't tell the full story. You can't walk away from this video thinking that you're either ahead or behind based on these averages alone. The truth about retirement planning is that your personal number has almost nothing to do with the averages. From your lifestyle expectations to your pension situation to the tax efficiency of your savings, we find that most people's real retirement numbers are dramatically different from what they assumed. To help you take that next step, I've created a separate video that dives much deeper into everything we've discussed today. In this video, I'll show you the exact framework I use with my clients to create retirement plans that actually work. You'll learn how to avoid the common pitfalls that trip up most pre-retirees and discover the specific strategies that can help you create the retirement lifestyle you've always wanted.